Clemens Jungsthöfel, CEO of Hannover Re, joins us now. Clemens, thank you so much for being with us. It looks like Q2 was a bit easier for the business than Q1. Talk to us about the main factors that drove net income over the course of the quarter.
Yes, good morning, and thank you for having me on the show. Yes, as you said, I think we've been able overall for the first 6 months to deliver a very solid performance. We've been able to generate further profitable growth with our clients, and the net income for the first 6 months of 1.3 billion euros leaves us very well positioned to deliver on our full year target, which is 2.4 billion. So as you said, the first quarter was very much dominated by the California wildfires, which caused an overshoot of our budget that we had allocated for the first quarter. Whereas the second quarter was much more benign, particularly in terms of nat cat losses. So this is a good reminder, first of all, that there is volatility, of course, in the business, but that a quarter, just a single quarter, is not a good indicator of a performance. So again, I'd say at the end of the second quarter, fully back on track to deliver on our targets. What I should stress, though, is apart from the strong operating performance, we've been able to further strengthen our balance sheet, and that allowed us to really manage volatility over the cycle and to deliver on our targets over the cycle.
In terms of preparing for future losses here, because clearly, as you've just outlined, and as investors are well aware, Q1 was a much more difficult quarter than expected, given the Los Angeles wildfires. What are you doing in terms of reserve build to help prepare the business better for future losses?
Yeah, it's really, first of all, is of course looking at price adequacy. And when we look at the market environment, we are still, although prices have come down from a peak level, we are still in a very attractive and adequate pricing environment. So pricing is absolutely key. And then, of course, modeling, looking at climate-related perils, particularly what we've seen also in the first half year of this year, again, is a continuation of a long-term trend of an increase in climate-related perils. So capturing that in our models, in our prices, and then, of course, really making sure that you have robust reserves to manage volatility that comes from climate-related claims, that comes from geopolitical and macroeconomical volatility. And Hannover Re has been known, and we've been particularly focusing on this in this year again, to build a rock-solid balance sheet, to be able to really look through the cycle and manage volatility over the cycle. So that's very much our model, how we manage volatility.
Clemens, fascinating looking through the numbers. Very good to see you today, sir. You just mentioned there, and I just wrote it down, increasing climate-related perils, which every one of our viewers and every one of your clients is clearly aware of. Having said that, you also commented on the mid-year reinsurance renewals in your copy, saying it experienced modest price declines. So that begs me to ask the question, are you being paid suitably for those increased peril concerns and the insurance on them?
Yes, again, continuation. I think if we look at the first half year of 2025, it's very clear, although the first quarter has been dominated by the California wildfires, it's clear that particularly from secondary perils, when we look at the US, for example, convective storms, etc., that they are increasing year on year. So that's really important going forward. When it comes to the market environment, I think I would characterize the market by an increase in reinsurance capital and the willingness from reinsurers to deploy that capital. That has created some pressure on pricing, most pronounced, as you said, Steve, really on I would say, property cat lines of business. Other lines of business more stable. I would say casualty slightly up. So conditions, I would always look at it twofold. First is price. As mentioned, prices have come down from very peak levels, but then also terms and conditions are very important for the quality of the portfolio, and they held firm. So overall, I would say the rates are still attractive and adequate. So we continue to grow our portfolio together with our clients going forward.
As a client of insurance products, I don't like to ask the next question, but as an observer of your industry, I don't understand how premiums can't go up. I mean, you talked about California wildfires. I'm just back from France where they've got the biggest wildfires, I think, since 1949. You've got temperatures of 40 degrees plus in Florence, of all places, let alone further south in Europe as well. Yellow and red warnings galore in Spain as well. Clemens, it's becoming a very, very dangerous arena for you to price insurance in, isn't it?
Yes, it's become more complex. It's clearly a more complex environment that we are operating on, in not only when we look at climate, but also at macroeconomic, geopolitical trends, etc. But still, that's really what we are here for. We reinsurers have the capabilities, we've built the knowledge, we've built the models to price this. And on the property side, we are able to adjust prices, mainly on a yearly basis. That's what we talk about when we speak about renewals. So prices on nominal terms, Steve, have gone up actually. But when we talk about price reductions, we really mean on a risk-adjusted basis, hence inflations and things like that are built in. So that's why we continue to grow our book. That's why we've seen substantial growth in the last couple of years, because there's clear demand to deal with this increased volatility, particularly when it comes to climate-related perils.
Clemens, it's Karen jumping in. Let me bring up the word volatility again at a different context around investments, because what we've gleaned from talking to a number of other players in the industry is that it was a very wild period, particularly for fixed income markets. And I can see that you were sitting on 60 million in losses in hidden fixed income losses. Do you just want to flesh out for us how you saw the last half play out for you on the investment markets?
Yes, generally I would say our investments are there to cover our liabilities. So we are very disciplined when it comes to asset liability management. So no bets on interest rates, and we manage also currency volatility. So therefore, more than 80% of our investments are fixed income securities to cover our liabilities. It's fair to say that we've built our portfolio more on the prudent side. And I think our performance over the last couple of years, but also in the first 6 months of this year, have proven that our portfolio is highly diversified and very resilient also to withstand some volatility that clearly is in the market. So we are actually pleased with the performance. Our ROI of 3.3% for the first 6 months is pretty much spot on where we want it to be. When it comes to the realized losses of the 60 million that you mentioned, it's purely the fact that with the interest rate changes, of course, we have some unrealized losses in the other comprehensive income as part of the equity. We've used the very good results in the first half years to realize some of that losses and to build in to increase our running yield in the portfolio even further.
Clemens, just a quick one on interest rates, because they have been higher for longer, at least in terms of the United States, as we've been waiting out for more of the tariff policy to unfold. If we're looking at a lower interest rate regime from here, does that cause some sort of strategy shift for you?
Well, we always adapt, of course, to the current market environment. In the investment side, so we really try to match our liabilities. So we have durations on the investment side that matches our liability. So therefore, that's not really causing an issue as long as you are matched on the duration. However, of course, if interest rates come down, that will have an impact on our bottom line long term, ultimately, but that will also feed into our underwriting pricing. So lower interest rates, of course, will also have a positive impact long term then on the underwriting results.
Clemens, thank you so much for joining us today. Clemens Jungsthöfel with us, the CEO of Hannover Re.